Hey, there we go. You're on.
Words on my face?
You do.
Don't fight.
Excuse me. We can all have your attention. Let's start this here. So I'm about to introduce Professor Susan Merrill Paul. She has a Bachelor's of Science in Accounting from Southern New Hampshire University. She also has a Master's in Business Administration. She has an Advanced Certificate in Taxation. And she's also an enrolled agent with the IRS. It's where you take an intensive 2-day test.
Two-day test.
To be able to sit with the IRS and personally represent clients when they're getting audited or something bad happens. And she gets to work with that. She has 16 years of tax experience, and she also even owns her own tax and bookkeeping business. So, welcome.
Well, welcome. We've got a couple more chairs down front if anybody wants to join us. I want to thank the Accounting Club for having me here today, and hopefully you'll all learn a little bit more about the educational credits that are out there. I do have a couple of updates as far as the new law for 2009 and 2010, which might be of interest. Yes, the Accounting Club. Okay. There are two different credits available. The whole credit and the lifetime learning credit. Both of those allow you to take a credit for your tuition and fees that you have for the college. It is a above-the-line credit, which means that after you calculate your income tax itself, the credit comes right off of the taxes, so it increases whatever refund that you might have. By zeroing out your taxable income, it zeroes out the tax. You can use the credit for yourself, your spouse if you're married filing jointly, or your dependents if you happen to be claimed by your parents. The qualifying expenses that we have are the tuition that you pay to the college, the fees that they require you to pay, and also other related expenses to that eligible educational institution. The eligible institution is post-secondary, so college, junior college, whatever you have, that's the type of education that will have this.
Can I stop you, please? Would law school have it?
Yes.
Thank you.
Yes. The institution itself has to be able to participate in the governmental student aid program. So if you're just taking a correspondence class that does not participate in the federal program for student aid, then it doesn't qualify for this type of credit. The first thing we do to calculate what expenses you are able to use for the credits is we start with the total cost of your tuition, your fees, whatever books that you personally buy from the college. If you buy it off the internet, they're not qualifying books. You buy it from the college bookstore, they're qualifying for this particular credit. And the relative expenses. These are the fees that you have to pay, the mandatory fees, in order to attend laboratories or different classes. You pay the expenses with cash, credit cards, however you take out the money, you have student loans, you'll take the deduction when you actually pay it, not when you pay off the student loans. You're going to take this credit when you actually pay the tuition. So taking a loan out for the student aid, you'll still be able to take advantage of the credit. Yes?
I was just having a question about the books. If I purchase them on eBay or Amazon or something like that, they don't count?
They don't count towards that. And that was very specific in the way that they worded the tax code. And I know it's cheaper to buy them on eBay or through another source that's out there.
Thanks.
Now, once we come up with 100% of all the expenses that have been paid to the college, we have to subtract out any non-taxable scholarships or military assistance or your employer paying for part of your education. Anything that you receive that's non-taxable, such as the scholarships, grant programs, If you take money out of a 529 program that your parents have set up years ago, or take it out of a Coverdale IRA account to pay for college education, you have to subtract all of that money from the total of your tuition and related fees. Then, once we have the remaining amount, that's the amount that we use towards the credit itself. Okay, the Hope credit is the first credit that we have. This is available for the first 2 years that you are in a college setting. You could not have completed the junior year of college. So you're looking at, if you start in the fall, then you have the fall semester where you are a freshman. You have the following spring semester where you're a freshman and the junior of the fall. And then you have the following year where you're a junior in the beginning of the year. You can choose which two of those 3 years that you want to take the credit for the Hope credit. So if you want to do it in the first year where you just take the fall classes, or you can do it in the second year and the third year, whichever one, as long as you have not yet completed the first 2 full years of college. The expenses that you have, basically we take 100% of the first $1,200 of tuition and related fees. Then we take 50% of the next $1,200. So the maximum Hope credit per student is $1,800. That's a sizable impact when you're looking at taxes. Excuse me. Again, you can use this credit 2 different years. And this credit is a per student credit. That means that you're able to, if you have 5 kids or your parents have 5 kids, they're all in college, you can take 5 credits. And the maximum credit would be the $1,800 per student. So you're looking at, what, $9,000 of tax credit right there. The second credit is the lifetime learning credit. This takes a maximum of 20% of all the qualifying educational expenses. Now this one has a maximum of $2,000 per tax return. So whereas in my example you have 5 children that are going to college, and you take the Hope credit for each of them because they qualify, you can get up to $9,000 of credit. But if they don't qualify for the Hope credit, you can only get $2,000 for everybody. So one is a per student rate, while the other one is a per tax return rate. Lifetime learning credit is unlimited. That's what it means, lifetime. So you can actually be a professional student, and you'll still be able to take the credit as long as it's through an eligible institution. Graduate school does count, definitely. And also involved in the lifetime learning credit are your continuing education credits. So if you are a nurse or you are an accountant and you take the CPA exam and you have to take continuing education credits, that will qualify for the lifetime learning credit. So this one is more expanded and it's easier to take advantage of throughout your lives. The one drawback is you cannot use the same credit for the same student and the same expenses. So if you take one student's expense as a Hope credit, you can't use the rest of their expenses towards the lifetime learning credit. In the example with the 5 children, you might have 3 of them applying for the Hope credit, and the other 2 that will meet the requirements of the lifetime learning credit. So you do have a choice of how to use them, but you can't use the same student for both. Both credits are phased out if your adjusted gross income gets too high. So here we have the phase out for a single individual. If you have an AGI of $48,000, or if you're married filing a joint return, it's $96,000. That means you're not going to get the full $1,200 or $1,800 or $2,000, excuse me. Single filers and married filers will not get any credit whatsoever if their adjusted gross income is greater than $58,000 or $116,000 respectively. Now those adjusted gross income limits increase every single year. So they are adjusted for inflation. One of the examples, Jules is a single taxpayer. She paid $2,900 in qualifying expenses for her daughter, who attended the University of Arizona full-time as a freshman. So how much is Jules' lifetime learning credit? Assuming that there's no AGI limitation, what would we get for Jewel for the lifetime learning credit?
2,000.
20%. 20% of 2,900 is 580. The maximum is the $2,000, but it's only 20% of the actual expenses.
So this is only good for like my parents, right?
Well, no, if you are a dependent of your parents, yes, they're the ones that are going to claim that tax credit. But if you're out on your own and you're self-supporting and you file your own tax return, that's when you're going to take the credit for yourself. Yes.
What if you're living with your parents, but you file your own taxes anyhow?
Well, are you a dependent of your parents?
Yes.
Then they take the credit on their return.
Thank you.
Can I stop you?
Go ahead.
What if it's 46,000 per year? He's not a dependent, all right? So he gets to get the lifetime credit. So it's still 20% of the 46,000.
That is correct. Even if they're self-sufficient, they earn their own money, he still gets 20% of what the actual expenses are.
But you said the maximum is 2,000, so.
Right. So in this example, they only paid $2,900. So if they paid $10,000 towards tuition, after subtracting out the scholarships and the grants that are non-taxable, and they end up with $10,000 of tuition, well, 10,000 times 20%, that'll give you the maximum of the $2,000 for the lifetime learning credit. Yes.
If the parents are divorced and one claims the child as a dependent, can the other person take the credit for if they're paying for the tuition?
It depends upon who is the custodial parent of that child.
Right.
If the custodial parent is somebody that actually has physical custody of the child, has the child living with them, not including any temporary absences, but lives with them more than half the year or the majority of the year, that is the person that has the right to take the tuition credits.
But if they're in college, they don't want to be there.
Well, that's a temporary absence.
Oh.
Somebody that goes away to college, like my nephew is down at UNH right now.
Right.
Their parents live up in Vermont. They're still, he is still a dependent of them because they're supporting him.
Right.
He's just away on a temporary absence from the home.
But you can't get more than 2,000, right?
Right, for the lifetime learning credit. No matter how many children that you have that qualify for education expenses, you can only take up to the $2,000 for the lifetime learning credit.
Thank you.
Yes.
One person can only qualify for these educational expenses after they begin paying the tuitions, correct?
The tuition is paid to the school. It doesn't matter what the source of the money is from. So you can take out a student loan and pay the tuition to the college with a student loan. You're eligible to take that credit, or your parents will be eligible if they claim you. Okay? It's not when you have to pay back the loan that you take the credit. The credit is always taken when the tuition is paid, no matter what the source is that is funding it.
But I would have to prove the tuitions. I would have to bring it to the IRS. I mean to the tax company, let's say H&R Block. I would have to bring it in there and show it to them, the tuitions.
Well, you'll get a 1098-T statement from the college that says how much tuition was paid. And that's going to go to, in your case, you had mentioned that your parents can claim you. So they would take that with them to H&R Block, as you mentioned, and they would calculate the tax for the parents, the tax credit, based upon their situation.
Thank you.
And if you had 3 brothers that are also in college, each one of them might be eligible for the whole credit or combined for the lifetime learning credit. I have a question over here. No? Okay, yes.
Can you do my taxes?
Of course. Talk to me afterwards. Okay, the second situation, we have Vern and Whitney. They paid $1,600 and $2,100 in qualifying expenses for their twin daughters, Kimberly and Janet, to attend the nursing program at the community college. Now, without regards to AGI, because we're not going to have time to calculate what the differences are, how much will their HOPE credit be?
1,600 and 1,800.
Okay. How about a total of $3,050? The first child, which had $1,600, we take the first $1,200, 100% of the first $1,200, and 50% of whatever is the next $1,200. In this case, $1,200 here, and then $400 was left over, so 50% of the $400 is only $200. So we add that together, it comes up with $1,400. The second daughter had $2,100. So we take the 100% of the first $1,200 and 50% of the remaining $900. That's how we come up with the $1,650. So combined on that tax return, we're able to take a tax credit of $3,050. Now, if your parents earn a lot of money, or if you're earning a lot of money, that's a sizable credit. And that whatever tax you're not paying, if you have enough withholding, you're going to get it back in your pocket. Next. This next section talks about the new laws concerning the HOPE credit for 2009 and 2010. This was a law that was just passed about, what, a month ago? Beginning of this month? I've lost track of time. It's tax season. So first of all, it modifies the HOPE credit for 2009 and 10. It does not affect the lifetime learning credit. It increases the maximum credit to $2,500. The credit phase-out has been increased, so more people will be eligible to get the HOPE credit. And it's available for the first 4 years of college rather than just the first 2. So it's a nice expansion on that. And textbooks are allowed. So in this particular case, I have to look at the specific wording of the law, but it gives the impression that textbooks purchased from other locations will be eligible. So that's a nice addition. And we know how much they cost. And it is refundable. Up to 40% is refundable with a maximum of $1,000. What that means is, usually the HOPE and the lifetime learning credit are non-refundable, meaning they only reduce your tax down by the amount of the credit, never to, only to 0, but never a negative number. So it just reduces the tax itself. Hold on. But when we say it's a refundable feature, that means that once you use whatever credit you need to zero out the amount of tax you have, you can get 40% of what's remaining, up to a maximum of $1,000, back in your pocket to spend. Yes?
So does that mean where I don't make, like, I have 0 tax liability to begin with, that means I can get up to 40% of my tuition costs back?
Up to $1,000.
Up to $1,000, so I can have an extra $1,000. I'm so glad I waited to do my taxes.
No, this is for 2009 and 2010, not for 2008.
No, okay.
Okay? Questions? Those of you that have had me before, I get a little dry when I keep talking. Go ahead. And the last part, it's allowed for alternative minimum tax. That means that we have another system out there of taxation for a flat tax called the alternative minimum tax. You'll have to take my class to learn a little bit more about it. But this credit is allowed. Usually no credit is allowed when you're dealing with alternative minimum tax. Question back there.
What if you've taken the HOPE credit before, like previously, like 10 years ago or something? Is it still just once per lifetime, or will you, so?
2 years that you've already taken.
Right, so I won't be able to be eligible for
Unfortunately not. You're going to be eligible for the lifetime learning credit though.
Yeah, no, I know that one. Thanks.
Yes.
So is there any way we can get like students that kind of get a couple grand in their pocket?
If you're a dependent of your parents would get the couple grand in the pocket. You'd have to talk to your parents about handing it over. Yeah, say please. What you do with your parents is you say, okay, this is how much I saved you in taxes. Where's my share? Okay, this is the example. Dick and Liz has a tax liability of $1,500 in 2009. They paid $4,000 in qualified tuition expenses for their son who's a college junior. So their tax liability is $1,500. The tax paid to the college, the tuition was $4,000. Under the prior law for 2008, they would only have a lifetime learning credit because he's a junior. Junior means that he's in his third year of college. So they only would have had the lifetime learning credit, 20% of $4,000, which is $800. Subtract the $800 credit from the $1,500 tax, they still have a tax liability of $700. Under the new law for 2009 and 10, they're eligible for $2,500 credit, $1,000 of which is refundable. So they reduce their tax liability down to zero using the first $1,500 towards the taxes, and the rest of it, 40% of the rest, maximum of $1,000, they get in their pocket. So you can see the instant changing, because here you're allowed to have the Hope credit for 4 years of college now as opposed to the 2. So that's a really nice feature. They actually gained the $1,700 with the new law. Any questions on the first part for the Hope? Any more questions that you might have? Okay, the other types of education benefits that are out there, student loan interest deduction, and the other one is the tuition and fees deductions that I want to speak about. When you have a student loan to pay for tuition, fees, books, and so on, you take the tuition credit when you pay the tuition. Later, after you graduate, you have to pay back the loan. And part of the loan that you're paying back is going to be the interest. The student loan interest, as long as it's a qualifying student loan interest, that means that you took out the loan to pay for educational purposes. It's for the taxpayer, their spouse, or their dependents. They were eligible student at the time that they took the loan out. It's limited to $2,500 per year of the interest portion that you're paying. So you're taking out your student loans now. Your parents might get the credit on their tax returns for the Hope of the Lifetime Learning Credit. But then when you graduate and you're out on your own and you're making all this money and you're paying back your student loan, you get to take the $2,500 maximum for the student loan interest that you've been paying. Of course, if you only pay $150 of student loan interest, you only get a $150 deduction. A qualified loan is used solely to pay for educational expenses. Now, if you take out the student loan, you can pay tuition fees, books, the supplies, the equipment. You can also use it for room and board. And the interest that you will have to pay in the years to come will still be deductible. Transportation, and also necessary expenses of attendance. Those are your lab fees and such. You have to pay those expenses within a reasonable period of time of being in that program. Expenses must occur during the period that you were at least a half-time student. And that's the half-time loan that is by the college. They're the ones that set up how many classes represent a half-time coursework. And this is either undergraduate or graduate level. Yes?
So, if you stop paying on your student loan before you finish school, you can still deduct it. There's no limit, a time limitation on how long, as long as you have the interest that you're paying.
Yes, that is absolutely correct. It doesn't matter when you start paying. Once you start paying any type of student loan interest, you can deduct it on the tax return. If you're claimed by your parents as a dependent, the parents get to claim that student loan interest.
If Can you deduct deferred, if a loan's under deferment, it's only when you actually pay it, not interest as accruing, correct?
Right, it's only when you actually pay the interest. In this part here, the adjusted gross income will also reduce the amount of student loan interest that becomes deductible. They always have something in the tax code for people that earn a lot of money. In this case, if you're married filing jointly, it starts to phase out at $115,000 and $55,000 for a single individual. And it's totally eliminated when you reach the levels of $145,000 and $70,000 for single individuals. The second deduction that's out here, this is a really nice one because if you don't qualify for the credits themselves, then you can take a tuition and fees deduction. Imagine that you have such a high income that you're phased out for the credits.
Can't imagine.
Can't imagine it? Okay. Well, what were they? 75, 50,000,
It was
55,
48
80?
and 96.
Okay, well, that's not much.
That's not much.
Yeah.
It's not much. But here, you're able to do one more. I think I have it down here at the bottom. The AGI limit is 65 and 130, and you're able to take a full $4,000 deduction. The tuition and fees deduction look only at the tuition paid and the fees that are paid. It doesn't look at any of the other expenses for education. So they look specifically tuition and fees. You take $4,000 of what you pay. If your AGI is too high for the Hope or the Lifetime Learning Credit, then if your AGI is less than the 65 or the 130, you can take $4,000 deduction right on the front of the tax return. If it's too high here, then you jump up to the 80,000 or the 160,000 phase out. So if you're between 65 and 80, or 130,000 to 160,000 for married people, you can still get a $2,000 deduction. Once you're above the 80 and the 160 for single and married filing jointly, you don't get anything. But this is a nice way to take a deduction when you can't qualify for a credit. It will still lower your taxable income.
Okay, what if his income is 56 or 58,000, then what?
Okay, 56 or 58, then he can either take the $4,000 on the front of the tax return, or you can take either the Hope credit or the Lifetime Learning Credit, whichever one he qualifies and gives him the best tax advantage.
But as far as the 4,000?
Yeah, because his income is less than the 65,000.
Less than, okay.
Right, this is less than
Okay, I got
the
it.
amount.
Thank you. Yep, okay.
The payments that you have for tuition and fees have to be for the qualified educational institution. The same rules as we talked about before. You have to be a student with at least one or more courses. So there's no limit to being a half-time student. Hope and Lifetime, well, Hope credit, you have to be at least a half-time student, carrying half the time of a full-time student load. Here, you can just take one course, and you're still able to take the tuition and fees deduction. And again, you cannot take this deduction for any elementary or secondary school. Some of the final options that are out there that hopefully parents have already set up prior to you coming to college, or you'll set up for your kids in the future. We've got the use of the savings bonds, Series EE or Series I. You buy them specifically from the government. You hold on to them until your child is in college. You cash them in, and as long as you can prove that tuition was paid with the amount of the face value of the bond and all the interest, then you never have to pay tax on the interest whatsoever. It is phased out at a higher adjusted gross income, and I have a handout that will have all that information. The Coverdell Educational Savings Account, that used to be the Educational IRA, or the Coverdell IRA. They just changed the name. That is available. You can set it up, put money into there with after-tax dollars. You take the money out to pay for educational expenses, and you don't have to pay tax on any of the earnings of that, as long as it's used for educational purposes. And you can switch around who the beneficiary is within the family. So if you plan it for your oldest child, but they don't want to go to college, you can give it to your youngest child. Or you can use it for yourself or your spouse, as long as it's used for educational purposes.
Can it be used for more than one family member? Say, like, your older child goes to college, decides he doesn't want to go anymore, quits. Can you then transfer it?
Yes, you can transfer it between the different beneficiaries. The last one is the qualified tuition program, otherwise known as Section 529. People have funded that with giving us a major contribution, like $50,000 or $60,000 into this fund. It's with after-tax dollars, so he's always paid tax on that money. When they take it out, as long as it's used 100% for education, and this is expanded, because this can be used for room, board, and a bunch of other educational expenses. You don't ever have to pay tax on the interest that's there. And the nice thing about it is the person that puts the money in is still has control over who the beneficiary is. And if nobody ever goes to college, they can take the money back after a certain age, and they can just take the money out and use it themselves. Excuse me. Yes?
What is the disadvantage from all of those three? Because I do not see that people often use it. If it's a good program, why old people don't go and use it? What's the disadvantage from this program?
The only disadvantage is that they can't touch it unless they use it for education or once they reach age 59 and a half or older. That's the disadvantage. If they don't have anybody that goes to college, then they might not want to even set it up. The nice advantage is that the earnings on it are totally tax-free when you use it for education. If you don't use it for education, you take it out, you're going to get hit with penalties and taxation on that. Yes?
Where can you purchase these? At the bank?
Usually the bank will help set them up. Some insurance companies also offer to set up the programs. I suggest talking with a financial planner first to see what your needs are for the future. There's some excellent financial planners up there. I know several that deal specifically with college planning. That if you'd like their name, let me know. I'll give it to you. Now, in 2009 and 10, the 529 program has been expanded. It also allows computer technology and equipment as a qualified educational expense, which they didn't have before. So this is a nice advantage. Now, you asked what was a disadvantage. If you don't have the money to put it in to start it up, that's a big disadvantage. If you don't know several years before your child wants to go to college and don't start setting up and planning then, that's a disadvantage. It needs to be set up, think about it when your child is just born. Start there, start thinking about what's going to happen for college education for that child. Talk to a financial planner, and when you're at the stage to get ready, once they're out of preschool and probably in high school, well, probably middle school or elementary school, you start thinking more about that for college education.
I know some people that actually started them when they were pregnant.
All right, that's great. They have good foresight to do that. Yes?
Susan, when my son goes to law school in the fall, will he be able to use the new computer that he's going to purchase, either desktop or laptop? Will he be able to take that as a deduction or no?
It depends upon what he falls into. Lifetime learning credit will only be tuition and fees. Okay. If it's work-related, is he already
Well,
in the
he's
legal
a school
system?
psychologist right now.
School psychologist, and he's going to law school for?
Educational and family law.
We might be able to find some case law that will support deductions, but that would not be in one of these credits, but it would be in one of the employment credit that is out there, employment deduction. See, worst case scenario, if you're going to college just because your work requires it or continuing education requirements for your certifications and stuff, basically, you look at the lifetime learning credit. If your AGI is too high for that, then you look at the tuition and fees deduction to see if you can take it there. If your AGI is too high for that, you look at your employment expenses, which are a Schedule A itemized deduction. There's limitations on that, but if it's business related, work related, you can still get away with taking the computer in that.
But he'd have to take it before the end of, or buy it before the end of the school year, right?
Right, and use it for the
Within
school
the
purposes.
context, right.
Yes.
Okay, thank you.
No problem. Any other questions at this point? Questions? Answers? Did you learn something?
Wonderful.
Okay.
Absolutely
Yes.
wonderful.
Actually, I have one question about the modification to the Hope credit. Now, right now, I'm in my junior year, so half of my junior year is in 2009, and the other half is in 2008.
Okay. Even though the college has an academic year of fall to spring, the credits are based on a calendar year.
Right.
So for 2008, you were a sophomore in January of 2008?
Yes.
Then you're still eligible for the Hope credit for 2008 if you did not take it 2 years prior. Because that was, at that point, it was only allowed for 2 years.
Right.
So now with the new law for 2009 and 10, you can actually take the Hope credit with the new laws for those 2 years.
Okay.
Yes.
I came in late, so I think I might have missed this. For both the Hope and the Lifetime Learning Credit, where's the documentation for that we would fill out in order to be eligible for it?
It's a tax form that is attached to the tax return. The only documentation that you would have is the 1098-T statement from the college.
Right, which we should have received already?
Yes, that should have already been out. And you would use that to complete the form. And you would have records you can get it from financial aid or the bursar's office here, that says exactly what you have paid. Some colleges actually show on the back of the form everything that they charge you for tuition and fees and everything that has actually been paid.
And which forms were those again?
That is the 1098-T, and then the educational credit form, which is in the 88 series. Do you remember what it was, Galena? 1090
Loan for loans?
for the lifetime learning credits, the educational credit form. Do you remember that? Okay.
For loan.
All right. It's an 88 series. It's either 8829 or 8839.
And you have to pay, it's based on just form. In my situation, I was in college in the springtime, and payment for springtime and fall time, and for next springtime was in the same form, so it was like too much for me. And because of our college require us pay till New Year,
Right.
I came here and thought, could they please pay 1st of January to move it to next 1098 yeah, and they didn't let me do it. So I have to pay, because right now I only need payment. So we deduct just based on this form. We can't deduct it just based when you take.
No, it's based upon when it's actually paid. Yes. So if you pay for the January semester, which we're in now, you pay it in the fall, you can take the deduction in the fall, not for the spring.
And for me it became like too much, and I think it's $4,000.
Oh, yeah, that's hard. Yes.
Now, say you received some of your tuition for last semester paid with Pell Grant.
Pell Grants are non-taxable, so you have to take the total tuition minus the Pell Grant, minus any scholarships, and whatever's left over for tuition and fees, that's what you use for the education credit. And the nice thing about that is, as long as the scholarships and the grants are not restrictive, saying that it's only for tuition and fees, use that towards your supplies and the other things that are not available for the credits, so you still have tuition and fees left over to take for the credits.
The tuition and fees deduction, which is line 34 on a 1040, the file, the form to file is 8917.
That is a new reporting. Before, you didn't have to file anything with that. You just had to put it on the front, and if there was ever a question, then they would just give you a nice little letter.
Okay, and the educational credits, line 50 would be form 8863.
8860, okay, that's the one, the series of 88. Thank you so much for getting that. If I could have the handout.
Sure.
And any extras, please just keep, and then I'll collect them afterwards. Thank you, James.
Yeah. No, you won't forget that.
Okay. What this is a little chart that I made up of the different educational items that are out there. It gives you the Internal Revenue Code section that it refers to. And it gives you some of the highlights of the different items. We have the Hope Scholarship, the Lifetime Learning Credit. They're all in the very first two columns. And then we have the Savings Bond Exclusion with some more details, along with the student loan interest. The qualified tuition deduction is the tuition and fees deduction on the front of the tax return. And then you have the qualified tuition program and the covered L. So this just gives you a little bit more detail in one spot.
Is this just for New Hampshire?
This is federal law.
So my future daughter, who's in Massachusetts in graduate school, could do the lifetime learning, right?
Yes, that is absolutely correct.
Oh, this is fabulous.
This is federal law. It's not state law. This is federal law because it's only available on your federal tax returns. If you're a resident of Massachusetts, Massachusetts has special credits for residents that go to Massachusetts colleges.
Okay.
So that's something to look at the state level for her. Okay? Thank you very much for coming today. I really appreciate it. I do have my email address here, spaul@ccafh.edu. You're more than welcome to give me an email, and if you have any questions that I haven't answered, I'm available. I have my classes here all day today on Thursdays. And as a last little note, I have something that I received that I think you might like to hear. This is a news release that came out in the beginning of '07. The IRS supposedly did an audit of their books for all the taxes that they collected in 2006. And they said that they had a surplus, which is amazing. So what they're going to do is they're going to send out refunds between $3,000 and $6,500 for a married couple and $1,500 to $3,250 for a single individual.
Is this a joke?
Let me give you the speech.
Is it April?
Let me give you the speech that. We have to leave on a nice, happy, funny note.
For a second, so I can write down something.
Which one?
The previous one.
The moment's passed.
The previous one?
No, the other one.
Which one would you like to leave? Not true? Do you want, if you
No, I wanted to just take a look at that other one.
This one? If you want me to email this to you, I'll be happy to email it to you.
Okay, thank you, Susan.
I am. I'm here.
Thank you.
Thank you.